All right, in this video, we are going to look at a similar video to the last one, which has to do with taking income from a life insurance policy because I've got certainty with guarantees and the fact that it is tax-free, but setting expectations properly is key. So like the last video, we'll look at different assumptions, an aggressive rate, a conservative dividend rate, and then also the worst case with the guaranteed values. But we're going to look at things a little bit differently here. We're going to hit on a topic that a lot of people have interest around, which is how to maximize the internal rate of return of a high cash value life insurance policy. And we're going to use what we looked at in the last video as a foundation. So we're going to look at a 50-year-old male, and in this example, we're going to fund a policy at $100,000 per year, just like the last video. But if you've seen the last video, do you know how long we paid into that policy? For 10 years, a total of $1 million. In this video, we're going to fund the policy only for 7 years. Now, the key to 7 years in life insurance policies is that it is a great way to maximize the internal rate of return. It has to do with the 7-pay test, which is another name for the MEC test. In summary, or just in short, I can fund a policy aggressively for 7 years, right up to the MEC limit, and then stop funding altogether. I can continue to pay, but we're going to stop funding altogether, look at what's called a reduced paid up option, and just juice that internal rate of return. Won't be a huge difference, because we're going to look at the same individual, same company, same product, same health rating. Everything's the same except for the designs are tweaked a little bit, and we're stopping funding after 7 years. So let's look at the designs first. So in our last video, what we looked at was this guy. So this is the basic dividend rate. So to go back, we're going to look at different assumptions. We're going to look at that indexed crediting rate, which is an aggressive way to illustrate income. Then we're going to look at the current dividend rate, conservative dividend, and also the guaranteed values, which represent a worst case scenario. Now, what we're going to look at first when we compare the examples and how to maximize the internal rate of return is just looking at the basic dividend rate. This is typically what you'll be presented whenever you look at a high cash value life insurance policy or any whole life insurance policy. What the assumption is often based on is the company's current dividend interest rate. This is their non-guaranteed values in this example. So first off, let's take a look here. Where's the money going? This is what we looked at in our last video, the 1 million over 10 years. There's your base premium. Here's your term rider. Then everything else is going toward PUAs. Technically, that PUA payment of 90 grand, approximately 90 grand, first the 1,300 and change comes out of the PUA payment to satisfy the term cost, then everything else is directed toward PUAs. Now, again, this is the exact same example we just looked at in the last video, 1 million for 10 years. There's your cash value, 1.133. You saw the beginning of the last video. We use the indexed rider first in the illustration, just in case you're remembering or wondering why those values look a little bit different. Here's what I want to hit on though, this is very important. Your total death benefit in this example is $2.3 million. Your whole life death benefit is just about 10% of that, $230,000, $231,000, which gives you a 10K base premium. This company will allow us to illustrate a little under 10%. We can set it as low as about 9.1%, so just below $9,100. However, the lowest this can be, the whole life death benefit, is 10% of the total death benefit, which we needed that figure to prevent a MEC. So why I mention that, because it's a small detail that is important when you see the difference in value here, is when we look at the next example, you'll notice that that premium is slightly less, $9,090.91, which gives me a whole life death benefit less than $230, it's at $210. What that means is if we go back to the 10-year example, we could not have this base premium with this product because that whole life death benefit would be less than the $2.3 million. This is a long-winded explanation as to why this base premium is about $900 less. Now, let's continue on here. We had to add a smaller term rider because we're funding only for 7 years in this example. So less expenses, right? Which is a small difference, but it is significant to a lot of people. That little difference can make a difference. You're close to 85% in the first year now. Same product here, same health rating, everything. Smaller base premium, also a smaller term rider. So slightly less expenses, slightly stronger cash value up front. Do you remember what year 5 was in the cash value in the 10-year example? Here, the 7-year example, you're at 501. So there's your break-even point based on the present dividend values, not the indexed values. In this example, it's 496. So technically, we're not breaking even there. We're very, very close. But just to see, hey, on paper, is this my break-even point or not? From a peace of mind standpoint or comfort level, a lot of people like to see that actual break-even point. A couple of dollars below, it's just like, get it above. I just feel better with that. So we like to show it, or show it where we can at least. I mean, we can only show what the numbers produce. But 7-pay compared to the 10-pay. Slight differences, mainly up front. If we look at a side-by-side comparison, here's what you'll see. So we've got the annual internal rate of return. Beginning year 11, when we're not funding anything to these policies year over year, the annual IRRs will be about the same. However, if we look at the first 7 years, everything above this line, what do you notice here? Not a huge difference, but there is a difference. It's about a full 1% in the first year. You get 84.5 compared to a little under 83.5. So about $1,000, a little bit more. As time passes, there's your break even year 5. Over here, it's year 6. By year 7, there's about a $7,000 difference. And again, right, it's $7,000 at the end of the day. Some say that's not material, some say it is. We like to just show the numbers and go through it. All right, internal rate of return. I almost forgot a point that is very fun to talk about. The IRR. Typically, when you look at a reduced paid up, in year 8, you'll see a nice jump there. And this will be the case with most whole life insurance products with most companies. Over here, we executed a reduced paid up option in year 11, so a little bit later, and it's a similar output, but slightly less compared to doing it in year 8. So you'll typically see that trend, which is nice, just when I'm looking to maximize cash value and get the most out of my money. So let's take a look at the income scenarios now, shall we? So first, we've got the growth samples side by side. Whenever we're going to look at income, it is beneficial to see everything side by side. Specifically, what does my policy look like based on the present dividend interest rate, which is what we just looked at. We see it right here, dividend rate 5.65%. This is that illustration we just started with and compared it to the 10-year fund. If I look at the indexed rider, starting with the best case scenario, right, that's using the S&P 500 index. This is merely a projection because there's no way to actually project that. This is based on the past 25 years of market history. There's my projection. Conservative dividend rate. When you're looking to take income from a policy, or even when you're looking at growth models, beneficial to look at this kind of stuff. If someone's resistant to show you this, I would ask someone else. Right? It's very important. If someone's resistant to show you this, I don't know, I feel like they're hiding something. It's your money at the end of the day going into a policy. Then you've got the guaranteed values. Absolute worst case scenario. There we go. Year 8. So this way I can see everything up front. It's pretty cool about this with the 7-pay. Remember what the guarantees were? The break-even point in the 10-year fund is year 11. So with that 7-year funding example, you get an earlier break-even point. Typically between years 8 and 9, it's right around the earliest we'll see it. If we rewind the clock before 2022, when we still had a guaranteed rate of 4%, that's where we could often see it. Year 5, often between years 5 and 6, with a short funding scenario like this. But that's just discussing history. So we've got the growth scenario. Let's look at the income scenarios now. So we'll begin with the best case and then pull things back down to reality. Indexed rider first. Total payments of $100,000 going in. $100,000 for 7 years, so a total of $700,000. By the way, what most people do here that we work with, this is great for income, but they're interested in accessing that cash value for opportunities. Remember, you still have the loan feature. You can access the cash value all the way through. And what happens when you access the cash value through a loan? You continue to receive compounding on your entire cash value asset, money that's still in equity and what you have borrowed against the policy. No lost opportunity cost. If it's direct or non-direct recognition, that'll make a little bit of a difference, but typically that doesn't matter really when you look at actual results, not just projections. So here we go. Income, $67,000 per year. At the end of this video, I'm going to show you something else to make that look a little bit better, but it's something that we want to be aware of more than anything else. So you've paid in a total of $700,000. Then you start to pull out $67,000 per year. So this is income you are receiving. What this represents, you paid in $700,000, and then as you start to take money out, here at age 75, you see negative $37,000. What that means is you've paid in $700,000, you've gotten $700,000 back, and then another $37,000 on top of it. So you've exceeded your cost basis. During the first, about 10 years of income, we were taking out policy withdrawals, not a loan. You can, but in this model, it's just withdrawals up to our cost basis. If we withdraw beyond our cost basis, what happens? Taxable as ordinary income. So we withdraw. Once we have pulled out withdrawals, a full $700,000, now we begin to take loans without paying any loan interest, without paying anything back, of $67,000 per year. There's the distributions, okay? Come on. And there we go. Pulling it through age 95 here. You've pulled out almost another 1.4 on top of the 700 that you've paid in. So the total dollars that we pulled out of this policy beginning age 65 are closer to 2.1 million if we factor in our payment as well. So there we go. $67,000 per year. If we look at the dividend here, $54,500 per year. So more conservative. Don't just settle for the best case scenario. The last thing, if I'm being presented anything but a life insurance policy or something where I'm banking on using this for income in retirement, I don't want to be shown just the best case scenario, thinking that's what I'm going to get for a number of years, and then told at the end of the day when I actually come to pull income, oh, you can't pull out that much because dividends have come down. Well, I would have liked to have been made aware of that up front. That way I could have made a better decision at that point in time. So I just want that information or have someone asking those questions for me. Very important here. So you've got the $54,500 each year, much less than the indexed assumption. That's the purpose of this. We still pull out our $700,000 plus about another $1 million. And if we died at 90 here, so you've pulled out 700 plus another 717 in loans, have not paid anything back, and then the net death benefit is that $615,000. In this particular example, based on a 50-year-old male funding a policy at $100,000 per year for 7 years. Conservative dividend. So the company's present dividend rate is 5.65%. Here's a dividend rate of 4.33%. Much more conservative. Also referred to in the industry as a midpoint dividend. Scroll down here. Look at the income here. It's less. 40,000 and change. 40,500. We still get more back than what we paid in, which is good. And then lastly, the guarantees. Absolute worst case scenario. What does this look like? $30,000 per year. We could pull out a little bit more than this. I just ran it ultra conservative. And there we go. Pulled out your 700 plus another 230 on top of it, remaining cash value and death benefit at age 95. So I know I zipped through those. What I like to look at here is everything side by side. So there's your guaranteed rate, conservative dividend, current dividend rate, income side by side. Guarantees 30, conservative dividend just over 40, and then present dividend close to 55. What will I actually get, Steve? Like, what can I realistically expect? I would peg it somewhere between these two. You know, if you said, hey, if I want to set expectations knowing I can pull out 40, maybe even 45,000 per year If I want to take a level income from the policy, you'll probably be able to do that just based on what we've always seen with whole life insurance policies in performance. It is something we'll track over time. So if what I said, that 40 to 45 does change, perhaps it gets much better than that, especially as we near retirement. As we have review meetings, track the actual performance, look at in-force illustrations, we'll really keep our finger on the pulse of your company, of the product, the company, the industry, so you always know, here's how much I can pull. Because things will change. Maybe your funding adjusts. Maybe your financial situation adjusts. Things change, so we make sure we adjust accordingly. Now, I said I was going to look at different examples here. There's your indexed example with the $67,000 per year. Remember that? Look at this. So here is the same thing, indexed rider, but the variable rate, and we can do this with the dividend rate as well. But what I would caution many people with is when you're looking at life insurance projections and looking at income in retirement, is if a variable rate is shown, make sure that we're requesting a higher variable loan interest rate, and not by 0.5%. When we show more aggressive loan rates, I'll give you an example. MassMutual's 10-Bay policy has a floor, a variable loan interest rate of 3%. That's come up over the past 2 months. And we've seen some situations where people are shown maximum income with very low variable loan interest rates, and it's going to assume that low variable rate forever, that it never changes. So when we're going to look at a variable rate, what I like to look at or provide awareness around the fact is, here's your 3% rate, maybe it's 3.5%, and then here's what it looks like if you have a 5, 5.5%, or 6% variable loan rate. This way, we're significantly increasing it. This way, if I'm the consumer, I see that and think, okay, if rates go up, which maybe they will go this high, and this is a long span of time as well, they could be higher, here's the impact it has on my policy. I don't want to just be shown numbers that look the best, so I move forward with a particular agent because they were able to produce more income. That's a trap that a lot of people have fallen into over the years because these projections are one thing. We've got to be aware of the reality and what that provides, or what actually happens here. So why I mention that is here's a variable loan rate at 4%. The fixed rate is at 5%. The variable loan rate also makes the policy non-direct recognition, whereas with this example, the direct recognition ends up hurting us a little bit down the road from an income standpoint, from a projected standpoint, not the guarantees though. Anyway, by switching that loan rate to variable, I'm able to model a greater amount of income, $72,000 per year instead of $67,000 per year. That's another $5,000 per year, which per year might not seem like a lot. Over time, that adds up. And my impact, the end of the road is similar. We aggressively try to pull out more. I could increase that to about 68.5 to have similar results here. But I've got significantly more income over a long duration here by modeling a variable loan rate, which is at 4% in this particular example. Awareness is key. If we're going to look at variable loan rates, what I like to look at, and this is several extra steps. If you're an agent, you might seem like this is a lot of work. It is, but remember, it's people's money that we're dealing with. We've got to set expectations properly. When expectations are not set properly, that's where a lack of awareness results in hate speech toward whole life insurance. I got scammed, I got ripped off. Well, if you're upfront about that and provided awareness, the issue would not have occurred. That's what's so important here. And you'll learn as you go. I have, and I'm still learning all the time. But with that variable loan rate, it'll project more money there. So make sure we're showing different options. Before I lose my train of thought, I almost started something and didn't finish. Looking at more aggressive, higher variable loan rates, and then also conservative dividend interest rates, like we have in all of these examples. So hopefully this helped. If you'd like to see any policies with income coming out, or maybe it's just how to maximize growth, perhaps it's how to maximize the death benefit, maybe it's looking at loans for real estate, whatever it might be, we're always happy to help and discuss high cash value life insurance as we have a lot of fun with it. I do hope that you found value in this video. If you did, please hit the like button, subscribe for more. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.